Most people believe top investors have secret information, hidden access, or insider advantages that ordinary people can never touch. That belief is comforting because it explains failure without demanding change. But the truth is far more uncomfortable. The greatest investors in history didn't win because they knew more news. They won because they followed a disciplined playbook that almost no one has the patience, emotional control, or long-term vision to execute. This playbook isn't exciting. It doesn't promise overnight riches. And that's exactly why it works. Today, we're breaking down the real, repeatable strategy top investors use to find winning stocks before the crowd understands what's happening. They start with business quality, not stock prices. The biggest mistake amateur investors make is starting with the stock chart. Warren Buffett has repeated this for decades. A stock is not just a ticker symbol, it is ownership in a business. Top investors begin by asking brutally simple questions. What does this company actually do? How does it make money? Why do customers choose it over competitors? If those answers are unclear, the stock is ignored no matter how exciting the story sounds. Buffett built Berkshire Hathaway by focusing on companies with durable competitive advantages, like Coca-Cola and American Express, long before obsessing over daily price movements. Peter Lynch followed the same logic at Fidelity, famously saying, "Know what you own." Business quality means consistent revenue, understandable products, and leadership that has proven decision-making discipline. Investors who focus on business strength don't panic when prices fall, because they know value exists independent of short-term market emotion. The stock price is the last thing top investors analyze, not the first. They look for moats, not momentum. Momentum attracts crowds. Moats protect profits. The best investors obsess over competitive advantages that are difficult to copy. These moats can take many forms: brand power, network effects, cost leadership, regulatory protection, or switching costs. Jeff Bezos built Amazon's moat through scale, logistics, and infrastructure that competitors couldn't easily replicate. Microsoft, under Satya Nadella, strengthened its moat by embedding software deeply into enterprise systems, making it painful and risky for companies to switch providers. A stock with momentum can rise fast, but it can fall even faster. A stock with a moat compounds quietly over years. Charlie Munger emphasized that a great business with a strong moat can forgive small valuation mistakes, while a weak business never will. Top investors don't chase what's hot. They look for businesses that competitors struggle to attack, even when the industry becomes crowded. Moats turn growth into durability, and durability is what creates long-term winners. They wait for mispricing, not perfection. One of the least understood truths about investing is that great companies are often terrible investments at the wrong price. Top investors are not constantly buying, they are constantly waiting. Howard Marks built his reputation by understanding market cycles and investor psychology. When fear dominates, prices disconnect from reality. That's when opportunity appears. Mispricing happens when emotions override logic during market crashes, sector-wide sell-offs, or moments of extreme uncertainty. Benjamin Graham, the father of value investing, taught that markets are voting machines in the short term and weighing machines in the long term. Top investors don't need perfect timing. They need enough margin of safety that mistakes don't destroy them. They buy when pessimism is excessive and sell when optimism becomes dangerous. This patience is rare. Most people want action. Professionals understand that weighing is an action, and often the most profitable one. They study management like partners, not celebrities. Leadership matters more than spreadsheets. Top investors analyze executives as if they're choosing long-term business partners. Are they disciplined capital allocators? Do they speak honestly about risks? Do their actions match their words? Elon Musk, for example, divides investors sharply, not because of Tesla's product, but because of how people interpret his leadership style and execution risk. On the opposite same side, investors trust leaders like Tim Cook because of consistency, operational excellence, and predictable decision-making. Great investors read earnings calls, study past decisions, and track how management behaves during hard times, not just good ones. They avoid leaders who chase hype, issue vague promises, or constantly change strategy. Management doesn't need to be flashy, it needs to be rational. Over time, poor leadership destroys even great businesses, while strong leadership can turn average businesses into exceptional investments. They think in years, while others think in days. Time is the most powerful advantage in investing, and it costs nothing. Yet almost no one uses it properly. Top investors design their strategy around long-term compounding, not short-term validation. Ray Dalio emphasizes understanding cause and effect relationships that play out over economic cycles, not daily headlines. Long-term thinking allows investors to ignore noise, survive volatility, and benefit from exponential growth. Stocks like Apple, Amazon, and Microsoft didn't become giants because of one great year they compounded over decades. Short-term thinkers sell at the first sign of discomfort. Long-term thinkers expect discomfort as part of the process. This mindset shift is critical. The market transfers wealth from the impatient to the patient. Winning stocks often look boring for long periods before suddenly becoming obvious to everyone else. By then, the real gains are already behind the early investors. They control emotions better than they control information. Access to information is no longer an advantage. Emotional discipline is. Fear and greed destroy more portfolios than bad analysis ever could. Jesse Livermore, one of history's most famous traders, made and lost fortunes multiple times, not because he lacked skill, but because he struggled with emotional control. Top investors build systems to protect themselves from their own impulses. They set rules. They define entry and exit logic. They size positions carefully. When markets crash, they don't panic, they review fundamentals. When markets soar, they don't chase, they reassess risk. Emotional mastery allows investors to act rationally when others are frozen or reckless. This is why experience matters so much in investing. Every market cycle teaches humility. Those who survive learn that being calm is more profitable than being clever. They accept that losses are part of winning. No investor wins all the time. Not Warren Buffett, not George Soros, not Peter Lynch. The difference is how they treat losses. Top investors expect mistakes and design portfolios that survive them. They diversify intelligently, cut losses when the original thesis breaks, and avoid overconfidence. Soros famously said, "It's not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong." This mindset removes ego from decision-making. Losing stocks are not a personal failure, it is a data point. What matters is whether winners outweigh losers over time. Investors who seek perfection freeze. Investors who accept imperfection improve. This acceptance creates resilience, and resilience is essential for long-term success. They track capital flows, not just company stories. One of the most overlooked tools top investors use is understanding where money is actually moving, not just what companies are saying. Great stories don't move stocks, capital does. Institutional investors, pension funds, hedge funds, and sovereign wealth funds move markets through allocation decisions that take months or years to unfold. Top investors pay close attention to capital flows between sectors, asset classes, and geographies. When interest rates change, money shifts from growth stocks to value stocks, from equities to bonds, or from developed markets to emerging ones. These shifts create winners long before headlines catch up. Stanley Druckenmiller built his legendary career by focusing on macro trends and liquidity cycles, understanding that fundamentals matter most when capital is aligned with them. A strong company fighting against unfavorable capital flows can stay undervalued for years, while an average company riding a wave of liquidity can outperform expectations. Top investors don't blindly follow flows, but they respect them. They wait for moments when solid fundamentals and favorable capital movement align. That's when winning stocks don't just rise, they accelerate. The secret playbook top investors use isn't hidden, illegal, or complicated, it's just uncomfortable to follow. It requires patience in a world addicted to speed, discipline in a culture driven by emotion, long-term thinking in markets obsessed with instant results. Winning stocks aren't found through hype, rumors, or prediction, they're discovered through understanding. Businesses waiting for opportunity, trusting compounding, and mastering yourself. The greatest edge in investing isn't intelligence or access, it's behavior. And once you understand that, you stop chasing the market and start letting it work for you.